Here are 5 important things to remember before investing in index funds. First, find out the expense ratio. Now, the expense ratio is the fees charged by the investment company to manage the funds of investors. A reasonable expense ratio for an actively managed portfolio is about 0.5% to 0.75%. For passive or index funds, the typical ratio is about 0.2% but can be as low as 0.02%, and this is why investing in index funds is more attractive than active funds. Second, find out the tracking error. Now, the tracking error in simple terms is how much the fund's performance has deviated from those of the index. Ideally, the returns of such funds should match those of the underlying index, but due to expenses and cash equivalent, it may be lower. Obviously, the lower the tracking error, the better it is for your portfolio. Third, find out the AUM or assets under management of the fund. Larger the AUM, more stable the scheme is and better to invest in. The AUM of funds are available in all fund fact sheets on the AMFI website, on Money Control, as well as on the company websites. Fourth, taxation of index funds. Now, being equity funds, index funds are subject to capital gains tax, and the capital gains earned by you for a holding period of up to 1 year, which is short-term capital gains, is taxed at 15%, and capital gains of over 1 year taxed at 10%. And finally, most index funds have an ETF, and for those wanting to buy in either the demat form and keen on intraday prices, you can also look at investing via the ETF mode.